In this lesson, we're going to take a look at another topic relating to inventory and cost of goods sold, and it actually has to do with the relationship between the two items. So what I want you to do is draw your attention to the inventory formula on our balance sheet right here under the new column. And you see that what I'm doing here is I'm basically taking the old inventory balance, and then I'm adding in the inventory change above in L13, and then I'm subtracting the change in cost of goods sold. And so in accounting terms, how inventory changes, the actual formula for the change in inventory is that ending inventory equals the beginning inventory plus inventory purchases minus cost of goods sold. So the beginning inventory is pretty straightforward to get. It's normally on the balance sheet, or we have some kind of indication of what the beginning inventory balance is. Similarly, the inventory purchases, they're usually not listed in the balance sheet or in the financial statements explicitly, but hypothetically, if we had the data, we could go in and decide how much it costs to actually purchase additional inventory. We'd look at the units and then the per unit cost, and that would be the inventory purchase number. But where this gets problematic is the cost of goods sold. And the problem here is that it gets tricky to decide what to actually use for the cost of goods sold in a lot of cases. Now, the way I've set up this model, it's very simple because I'm just assuming that the cost of goods sold change here is actually what we're reflecting in inventory down here, and that's how much the inventory changes by. But in reality, when you're actually working with a real company, it gets more complex than this. And to illustrate it, I'm going to go through a simple example that shows you the difference between the two main methods of accounting for the cost of goods sold. The first method being LIFO, and the second method being FIFO. LIFO stands for last in, first out, and FIFO stands for first in, first out. And those two terms may not make too much sense to you right now, but we're going to go through a simple tutorial that will explain exactly how these work and how the accounting treatment in each case here differs. So I'm going to go down to where I have some sample calculations here that show you the exact difference between LIFO and FIFO and how it affects a simple income statement as well as the inventory balance on the balance sheet. So to start with here, what I'm going to say is that we have a scenario where we have a beginning inventory. I'm going to say 10 units here, and we're adding to our beginning inventory throughout the course of a year, over 4 quarters of the year. We're adding to it by purchasing 10 additional units each quarter. So I'm going to take this 10 and just copy it down with Control V. And because of inflation, I'm going to assume here that the inventory cost is rising over the course of a year. So we're going to start off at $10 per unit. It's going to rise to 12 in Q1, then 15, then 17, and then 20. Now to get the value here, so the beginning inventory value, we're just going to take our units and then multiply by the unit cost. And for the rest of these, I can just take this formula, copy it with Control C, and paste it down with Alt ESF. So you see here that the value of the beginning inventory is 100, but then by the end, even though we've ordered the same amount of units, the value is now 200 because the units have doubled in price. Now, a scenario like this is not likely because inflation is not going to double the prices over the course of a year, but this is just an illustrative example to teach you the concept and to give you some round numbers to work with here. So that's the basic concept that you have to keep in mind here, that in general, over time, inventory prices, the cost to actually order goods, put them in inventory, and then manufacture them, those prices are going to be rising over time due to inflation. So I'm just going to sum up the total units here. So we have 50 total units in our inventory at the end of the year, and then the total inventory value. So at the end of the year, our inventory value, according to this, at least if you take the beginning inventory and then you add in all our purchases, is 740. Now what's missing from this is that the 740 here is not the real inventory value because over the course of the year we've presumably sold some of these units that we've ordered. So to account for this, I'm going to assume that 40 of these 50 units total have been sold. And the timing here we're not going to pay too much attention to. We're just going to assume that it happens throughout the course of a year and that we're selling these 40 units sometime within the span of this year before the end of Q4 here. I'm going to assume that each unit we sell for $30. So the $30 is above the 20 and it's above the 10 that we initially started with. So on our very simple income statement here, I'm going to say 40 times 30 for sales. So we have 1,200 in sales for these units over the course of a year. Now for LIFO versus FIFO, the way you calculate sales revenue is the same regardless of which one you use. So I'm just going to copy and paste this formula. Now where this gets interesting is with the cost of goods sold, the COGS line item right here. And the question becomes, what do we use for the cost of selling these 40 units? So do we start from the beginning here and go through all the way in Q3? Or do we start from Q1 and then go all the way through Q4? And keep in mind, we have no way of actually knowing which specific units have been sold here. So we cannot say, for example, that, well, we sold 5 units in Q1 of the Q1 editions, then we sold 10 units, all 10 units of the Q3 editions. If we could do that, then it would be easy, but it's just not possible to track things at that level, especially for large companies with millions and millions worth of inventory here. So we have to have some kind of estimate. So it turns out that the two ways that you could do this are LIFO and FIFO. With LIFO, last in, first out, what that means is that we start with the Q1 editions and then go all the way through Q4. With FIFO, by contrast, we're starting with the very beginning inventory number. We're assuming that we're using the cost of these first, and then we're going through Q3 to account for this. So for LIFO, what I'm going to do for the cost of goods sold is I'm going to start with the Q1 editions and go through Q4. And then with FIFO, I'm going to do the opposite. I'm going to start with the beginning inventory. So I'm starting at the beginning and then going up through the Q3 editions right here. Remember that we're assuming that 40 units have been sold in this case. Now for operating expenses, this does not change depending on our accounting method here, because operating expenses have to do with employee salaries, rent, other things like that. So I'm just going to say 460 for both of these. For pre-tax income, I'm just going to take sales minus COGS minus operating expenses. We get to 100 for LIFO and then 200 for FIFO. And then for net income, I'm just going to take pre-tax income and multiply by 1 minus the tax rate. Just copy that formula. So now we see the basic impact of LIFO versus FIFO. With LIFO, we're going to have a higher cost of goods sold because the cost of our inventory is rising over time. So our cost of goods sold is going to be higher, our pre-tax income is going to be lower, and our net income is going to be lower as a result. With FIFO, the opposite is true. Cost of goods sold will be lower, so pre-tax income and net income here will both be higher. So now to figure out how inventory changes. So for the beginning inventory here, we're going to start off at the same point for both these methods, which is the 100 that you see up here for beginning inventory. So for both of these, I'm just going to link up to the 100. And then for purchases, the same applies. Regardless of whether we use LIFO or FIFO, we're still going to be summing up all the purchases over the course of a year. So I'm going to use the sum formula and go up here and just sum up the Q1 through Q4 editions. I'll do that for FIFO as well. Now for the cost of goods sold, what we have to do here is for the LIFO one, we're going to link to our LIFO cost of goods sold, and for the FIFO one, we're going to link to our FIFO cost of goods sold. Remember that the FIFO one corresponds to the beginning through Q3, LIFO corresponds to Q1 through Q4. Then for the ending inventory here, what we want to do, remember the formula is that ending inventory equals beginning inventory plus purchases minus cost of goods sold. So what we want to do here is take our beginning inventory, add our purchases, and then subtract cost of goods sold. So we see that for LIFO, our beginning and ending inventory are the same. For FIFO, our ending inventory is higher. So that's an overview of how LIFO versus FIFO affects our accounting. Assuming that inventory costs are rising here, then for LIFO, the cost of goods sold will be higher, pre-tax income and net income will be lower, and then our ending inventory balance will also be lower because we've reflected a higher cost of goods sold. For FIFO, by contrast, assuming that inventory costs are still rising, then our COGS will be lower, pre-tax and net income will be higher, and then our ending inventory balance will also be higher. Now, if the opposite is happening, if inventory costs here are actually falling, then it's the opposite. Under LIFO, COGS would be lower, pre-tax and net income would be higher, and then our ending inventory would be higher. And then under FIFO, if the inventory costs are falling, COGS is higher, pre-tax and net income are lower, and then our ending inventory balance is lower. So that is how LIFO versus FIFO affects your accounting for cost of goods sold and ending inventory. Another way to do this would be to take the average of each of these. So this is called the average method. I'm just going to use the average formula here in Excel and take the average of these two line items for LIFO and FIFO under each category. Just copy this down with Control V and do that for inventory as well. So now we see that, as you'd expect, the average is somewhere in the middle. And usually companies will pick one of these methods. They may use LIFO, they may use FIFO, they may use an average. And if you read through the filings and you look for these terms, last in, first out, or first in, first out, or inventory, then you can usually find a description of what they're doing. But these are the three main methods that companies use to account for inventory and to account for cost of goods sold. Now in our model here, we do not have granular enough detail to fully support this, so I really went through this more as an exercise to teach you more about it, and because I've gotten a lot of questions on this topic, and it can potentially come up in interviews as well. I would say it's certainly a less common question than depreciation changes or inventory changes or even some of the more advanced questions that we'll look at later on, but it is something that could come up, and it's good to get an overview of how these accounting methods for inventory and cost of goods sold differ and how they affect the income statement and the balance sheet. So that is our overview of LIFO versus FIFO. Hopefully you have a better understanding of all that now, and you should be better equipped to answer these questions in investment banking interviews.